So now we're beginning macroeconomics in earnest, if you will. Many of these things we've already touched upon, and this is uh, this is pretty standard going forward as well, where we will be going over many of these topics repeatedly. But at any rate, so here's our introduction to macroeconomics. So to begin with, we want to identify or to define what that means. So the difference between microeconomics and macroeconomics. And the reality is that when it comes right down to it, all of economics is micro in terms of at the root of all of these things is microeconomics. In fact, going back probably to 1950 or in the 1950s, there was really no macroeconomics. It was anything that was approaching macroeconomics, and there was a lot, of course, that would have been more like an applied microeconomics, which is, that's a that's an understandable way of looking at the things, and it's split out with macroeconomics at any rate. So microeconomics, what we're doing is we're focusing on that circular flow of real economic activity. And taking it apart, first we're looking at what is being produced, if you will, the output mix or the product mix. So that again, pointing to that circular flow, going from the firm back to the household, and the household wearing the hat of what? Consumer. Okay. So we're going to go through the what, how, who, and why. The how has to do with how those productive resources, the labor, capital, entrepreneurship, and land are being utilized at the firm. How those productive resources are put together, are combined in order to produce that output mix or that product mix. Those useful goods and services for the household as consumer. So again, the the decider, if you will, again the decider in chief, of course, decision maker would be the entrepreneur at the firm. So again, that speaks to how. Who refers to that income distribution on the bottom part of that circular flow, going back from the firm to the household. Because remember, the firm is simply the place where production occurs, where costs are transferred. Cost meaning cost going forward to the household in the form of uh, um, the products that are sold to the household, the goods and services, etc. Correct? And conversely, also flowing back, if you will, to the household in the form of compensation, in the form of, again, the income distribution. So paid for the labor, capital, entrepreneurship, and land through wages, interest, profit, and rent. Breaking out, of course, wages would be paid to labor directly. Interest would be paid to the owners, if you will, of the firm, the owners being the equity capitalist and the debt capitalist. The equity capitalist would be the shareholders, stockholders of the firm, and the debt holders would be the bondholders of the firm, the lenders to the firm, in order to to do all those things that the firm would like to do. Anyhow, that would be the interest portion of it. The profit, of course, would be flowing through to any number of these uh, productive resources that are being employed, including labor. So there could be profit sharing for labor. There could be profit sharing for capital. Profit sharing for capital would come in the form of dividends for shareholders, and also the appreciation, the capital gain, if you will, in the stock. The share price of the stock going up. On the debt side, it would be the certainty of being compensated, if you will. Okay, paying that interest. Anyhow, the lastly, again, the profit could also be going through to the entrepreneur in the form of in the form of stock options and other types of bonuses that would be accrued would be would be accrued by the received rather by the entrepreneur. And lastly, when we talk about rent, that has to do with land itself. So the rent would be the barrel price of crude oil, for example, that's being pulled out of the ground. for the minerals, the leasing land, renting land, etc. The why, I just kind of throw this in here to kind of wedge international trade in here, but yes, it would definitely be a component. I look at it in terms of a micro side, but it could be micro and or macro, and I just choose to probably focus more upon this as a micro topic. Again, it can be either way. Um, and the focus of international trade, of course, is comparative advantage. That's the rationale, the reason behind all trade, whether we're talking about with your neighbor behind you that lives behind you or next to you or whatever, or across town, between states, in between countries, of course, in the form of international trade. Comparative advantage, of course, has to do with opportunity cost. You're going to be focusing your efforts on that which there's a lower opportunity cost for you. So example of that would be the U.S. Agricultural products in the form of wheat, corn, soybean, etc. Trading with a country like Japan, where that land is a bit more scarce. It's a bit more difficult and I say that facetiously, it'd be much more difficult to grow, various products in Japan, small, relatively speaking, place. So at any rate, that kind of sums up micro. And anytime you're drilling down on any portion of that circular flow, that is micro territory. So you could be talking about any of these macro topics as well. When we talk about macro, it's kind of the three-legged stool of macroeconomics, and that would be employment, unemployment, price level changes, and economic growth. So if you want to focus on a specific industry, again, even though it's a macro type topic or a macro topic clearly, it would be micro because you're drilling down on that specific area. Onward to macro again. Macro, we're looking again at big picture, obviously. And beyond that, again, the three-legged stool, as I just mentioned, employment or unemployment. So the next, of course, would be, it doesn't matter the order, but the next that I have here would be price level changes. That would be inflation, deflation, disinflation, and finally economic growth, which could be in many, many formats, but typically we look at it in terms of GDP or gross domestic product, which is basically the sale price of all these goods and services within that economy. That's when we're kind of exploding it out to that. So all the new vehicles that are produced in 1 year, that are sold in 1 year, et cetera, the sale price of those goods and services. Back to the unemployment. Currently, our unemployment rate is 3.4%, and that was for January 2023. Oops, I'm behind a little bit on this, but it's about the same actually. I think it's maybe up to 3.7% at this point. Price level changes again, looking at CPI. CPI, these are bit dated, and I'll be updating these as we kind of go forward. But at any rate, inflation, CPI, and the PPI have come down quite a bit. I think CPI is at about 3.3 and the PPI is at about 1% thereabouts. Currently, that's January 2024. CPI is Consumer Price Index, and that is the household as consumer, what we're paying for those goods and services that are being produced at the firm. And the PPI, that is the Producer Price Index. These are coming from the Bureau of Labor Statistics along with the employment or the unemployment data. It comes from the Bureau of Labor Statistics, which is under the Department of Labor. So PPI again is a producer price index, and that is what the firm pays for the respective productive resources, the labor, entrepreneurship, capital, and land, and all of the subcomponents that would be going into that. So again, what the firm is actually paying for those goods and services, if you will, to be used at the firm to transform those same productive resources into useful goods and services. So it's a passing on type of scenario typically, where if the PPI is high, then chances are it will be transferred on to the CPI in subsequent months. Again, inflation is an increase in prices. Deflation is a decrease in prices. A decrease in prices in terms of whatever that index is. So you're going from point A to point B always. You're measuring from one period of time to the next. Disinflation is that you still have inflation, but it's at a lower rate. So you may have inflation of 10%, and the next month you still have an inflation of 5%, but it's reduced. So that would be disinflation. And finally, economic growth, or GDP. So GDP, again, we're looking at that overall growth, and we're looking at real GDP in this case. So we're factoring, we're taking a look at it in terms of adjusting for that inflation. At any rate, this is a quick look at macro. So again, now we're looking at our circular flow on the left-hand side, the circular flow of real economic activity with the household, the four sectors. The four sectors would include, again, the household, firms, government, or the public sector. Firms would, of course, would be the private sector. So household, private sector, firms, government, public sector, and also the international sector. So there are four sectors. So looking again, drilling down on this circular flow, what we're looking at is we're going to start with injections. So we've talked quite a bit about the income distribution, the input mix, the output mix, etc. But now we're going to be focusing on the injections, or non-consumption spending. So absent that personal consumption expenditures, so all the other stuff that's out there. And I say that, and yet personal consumption expenditures constitute a huge portion of spending. I mean, probably 2/3 of spending or thereabouts is personal consumption expenditures. But aside from that, the injections, or the non-consumption spending, would include such things as the GPDI, which is gross private domestic investment. Government expenditures, they come in two stripes: the government consumption expenditures and gross investment. And then the last is NEGS, or net exports of goods and services. So you're taking exports and subtracting out imports to arrive at net exports, in essence, right? So these exports would all be considered injections. And anyhow, we balance these out when we talk about NEGS. So looking again, focusing on these injections, we'll start with the GPDI, or gross private domestic investment. That would be investment at the firm. And when we say investment at the firm, typically when we hear the term investment, we think financial. And yes, their financial investments are part of this. But in essence, what we're really speaking to when we talk about the gross private domestic investment, we're talking about the actual physical capital, the robots, the machinery and equipment that goes into the firm, the building itself. If there's some expansion or new building or whatnot, this would be all part of gross private domestic investment. And again, the idea being that it's all about the production, so when we talk about GPDI, why it is an injection is because you have to think about where it's actually being produced. And the GPDI, again, or the gross private domestic investment, those robots and machinery and equipment, and et cetera, are being produced at the firm. Who's consuming them? The firm. Nonetheless, they're being produced at the firm. And if they're being produced at the firm, that means that we are employing our productive resources from the household. So a household, as owners of those productive resources, they're being utilized by the firm, and of course they're being compensated by the firm in the form of that income distribution. And of course, the household with more income, the more income that they have, the income effect, the more income that you have, the more normal goods you will be buying. Hence, this is causing the economy to explode or to expand. So this is the rationale behind why they're called injections, or again, non-consumption spending. The next component would be government expenditures, and those come in two stripes. Again, government consumption expenditures and gross investment. So let's back up for a moment. When we talk about personal consumption expenditures, they also come in two different stripes. Those stripes being types, I should say, would be for non-durable goods and durable goods. it's somewhat of an accounting artifice. And what we're saying is that when we're talking about capital items or expense items, really, meaning capital items, meaning things that are long-lasting, long-lived assets, such as personal automobiles, appliances, hopefully. You get the idea. Longer lasting things as opposed to the, the 10 gallons of gasoline that you purchased last week to get to and from work. It's gone in a week. So those are short term. Those are non-durable goods. The same holds for, of course, for when we look at government, it drills down in the same manner in terms of government consumption expenditures. So those would be, again, short-term items, short-term expenses versus the gross investment, which would be long-term investments. So, for example, the consumption expenditures might be office supplies, and the gross investment might be aircraft carriers, for the government. The takeaway is that why are these considered injections? Again, government typically does not produce all that much, but it does produce education. It's public good, right? So education could be produced, and if you think about it in terms of a teacher's salary, what does a teacher do with their salary? They spend it. They consume. So this is all adding to that consumption, if you will. For the most part, government consumes. It spends. When we're talking about government expenditures, they are by definition expenditures, but they typically are buying things that are being produced where? At the firm. Okay, ultimately is really what we're driving at. And by doing that, then they're causing the household, the productive resources involved in this process are being compensated in the form of income distribution. And then again, with the more income that the household has, the more they're able to consume, the more they're able to spend. So those are government expenditures. And last would be exports. Same idea with exports. So think about exports in particular. The exports, you have to ask, where are they produced? They are being produced at the domestic firm. And if they're being produced at the domestic firm, then the productive resources from that at that domestic firm are being compensated in the form of income distribution, so you have more income. Again, with that, the downside is that you can't spend, you can't buy the things that are being exported because they're leaving the country. Nonetheless, you have more income. So this is why it's considered being an injection. Conversely, imports is not good or bad. I mean, we can get into that as we kind of go forward, talking about it a bit more. But the idea is with imports is the same way. Where are they being produced? They're being produced at another country in another country, so the income derived from that production stays within the context of that country, right? And of course, we get kind of a double hit because we're not producing it here, and B, we are actually the dollars, the money that we're buying those with, the funds that we're using are also leaving the country. So anyway, those are non-consumption expenditures or injections, if you will. Withdrawals are the other side of the coin in terms of like taxes and imports and saving. Those are the three that would be considered withdrawals or leakages. They're on their face, they're causing the economy to slow down. They're causing the economy to implode is typically the expression. Because remember, where does our income go? Our income goes to taxes. That's so it's taken out of our income. And then we whatever we spend, we're consuming again, causing the economy to grow. And whatever's left over, the residual, is saving. And so on their face, again, these are all withdrawals, whether we're talking about taxes, saving, and of course imports, as we said, the opposite of those exports. Onward we go. So if we talk about unemployment in the big three, for example, that would be considered drilling down on things. That would be considered a micro topic. Keep that in mind. So overall, the U.S. Unemployment rate going back to 2009. So this was in the midst of our Great Recession, if you will, was at 10%. In February 2020, I just want to give you some examples here. we were at 3.5%, and by May it had popped up to 14.8% as a result of the pandemic, as a result of COVID. So it's currently we're at about we're at about 3.4% unemployment rate, which is the same as it was last year. Again, we're showing 2023, but 2024 it's about the same rate. Um, Again, at any rate, when we talk about U3 unemployment, the U3 unemployment rate, youth to be counted as U3 unemployed, you have to be one, not employed, makes sense. But two, you have to be actually seeking employment. Okay, you have to actually be physically out there looking for employment. So back to the auto industry, when we talk about the state of the auto industry in the U.S., the domestic auto industry, this is just kind of as an aside, and these are old numbers. So keep in mind that especially with the problems that have been associated with moving more toward electric vehicles, or the electrification of vehicles, if you will. I suspect that GM and Ford have fallen off a bit. Maybe Chrysler's gone up a bit. I'm not sure. But at any rate, these are numbers that are going back to 2017. If we go back further, 60 years in fact, what you'll find is that at that time, General Motors had 60% of 90% of the market. So that total on the bottom was double, was 90% between the big three, those being General Motors, Ford, and Chrysler. And GM had over 50% of the market at that point in time. Times they have changed significantly, have they not? So all of us have heard about the economic cycle, business cycle. They're kind of used interchangeably, pretty much the same ideas. And that is that there's a tendency for the economy to rise and fall, ebb and flow. The tide goes in, the tide goes out, etc. So the business cycle, what we're looking at is that first off, it is a wave, and we're going to follow this. This is it's very typical. But what we have to understand, whenever there is a business cycle involved, what we're really looking at, especially when we have significant rises and fall, the amplitude and also the height and also the width, the extent to how long these kind of go on for. These ups and downs, these swings, they're pretty much indicative of what is market failure. When you have market power, when you have firms that are able to control prices, and we'll get into that more as we kind of go forward. But anyway, with the business cycle, we're at the top, and that's when we have full employment. So the economy is fully employed, and by definition, again, when we're talking about full employment, basically what we're saying is that it's typically about 3%, maybe 4% even, and we're currently about that range right now. So it's the reality is that we are, at least by most standards, we would probably be considered fully employed. But I do have some qualifications about that as we go forward in our discussion. At any rate, so assuming we're at full employment, and then what happens is that the economy deteriorates a bit. And at first, if you think about this, if you were the entrepreneur at a firm and you see a fall off in the demand for your products, so we're seeing demand failure. We don't know if it's fully demand failure or not. Demand side failure, I should say. In terms of like a fall off in the demand for our product, we don't know if it's long lasting or not. So the first inclination is not to lay people off. It's to just kind of reduce their hours or put them, work on something else, more maintenance, the equipment or whatever you can do to utilize those the workers that you have. Again, you could typically hours are cut from get rid of overtime for sure at first, and then kind of go from there. But you're really kind of hesitant about laying people off because people are expensive to train, honestly. And all the costs don't necessarily go away because you have to pay them unemployment and there are issues that kind of go along with it. At any rate, so the second thing that we see because of this fall off is the productivity decline, meaning we're not being as productive as we were before. The next, if this persists, if we continue on that downward trajectory, we have unemployment rising. So that U3 unemployment is starting to rise. You have more people seeking employment and not employed, right? So they've been kind of sidelined, if you will. The next item that we have, if it keeps going on for a very long time or extended period of time, we have what's called the discouraged worker effect. So when we have unemployment rising and the discouraged worker effect, the opposite occurs. Because remember, to be counted as U3 unemployed, you have to be what? You have to be unemployed, so you would still be unemployed. But if you gave up looking for work, you would no longer be considered unemployed. Hence, you end up with what's called the discouraged worker effect. And this happens when we've been going through an extensive period of time wherein we you end up just giving up looking for work. This happens too frequently. So anyhow, we have the discouraged worker effect, and if we go long enough on the discouraged worker effect, meaning 2 consecutive quarters, typically this has been our definition, or historically the definition of a recession is 2 consecutive quarters of real negative GDP growth. So the economy falls off, if you will, for 2 quarters, and a quarter being 3 months, so at least 6 months, right? So we're on the bottom and we're rolling along the bottom, then we start to pick back up again. And when we start to pick back up again, well, the first thing we notice is an increase in productivity, because just before, we were kind of loath to lay people off. Now we are hesitant about hiring people because we don't know if that was a false bottom or not. If we add more hours, so now you might be working more overtime. And anyhow, this is very, very typical. So the next step along the way would be what's called the encouraged worker effect, and that is that so you were on the sidelines before and you were unemployed or seemingly unemployed, but you weren't actively seeking employment, so you weren't counted as unemployed. So now you find that their jobs have been, on the rise and they become more plentiful. So again, as a result of which, more people are actively seeking employment. And we have what's called the encouraged worker effect. And with the encouraged worker effect, the odd thing about it is that unemployment rate actually goes up. So this is not a terrible thing. This is not a bad thing. This is an indication that more people are actively seeking employment. So this is when the economy is on the upswing. And finally, again, as we continue on, the unemployment falls in earnest, so that unemployment rate would drop and to go back to that full employment level about 3 or 4%. We would be back at the top of this business cycle until we go back down again. Anyway, so again, to be counted as U3 unemployed, you have to be 1, not employed, 2, you have to be actively seeking employment. And the actual unemployment rate is the U3 unemployment rate would be the unemployed divided by the labor force, and the labor force is equal to the folks that are employed plus the unemployed. So that's the denominator. And the unemployed would be the numerator. The numerator would be the unemployed, and the denominator would be the employed plus the unemployed, or that labor force. So the question that always arises when we talk about economics, and macroeconomics is usually the topic of conversation, with the media and people in general. We focus on the macro data, and there's a lot of it that's out there. And the two basic sources of this information would be the Bureau of Economic Analysis, which is under the Department of Commerce, and that would include like economic growth. Included within the BEA, or the Bureau, within the Commerce Department, would be the Census Bureau as well. They're the counters, so they do a lot of work for everybody, including the Bureau of Economic Analysis, but also on the Department of Labor side for the Bureau of Labor Statistics. So there are two basic sources of information we'd focus on in this class. One would be, of course, again, the Bureau of Economic Analysis for GDP growth, and the other one would be the Bureau of Labor Statistics, and they are the ones that are responsible for the employment, unemployment, but they're also the ones that track spending, or excuse me, the price level changes, inflation, disinflation, deflation, you get it. Anyway, so when we talk about the GDP, the one thing to keep in mind is that we really haven't had strong GDP going back to about 2005. I say that, however, so typically a sign of decent economic growth would be 3%. The reality is, and I've got this updated in a later slide, and that is that in 2018 we actually did hit that 3% real GDP mark. So we were on the right path, and then what happened? Along comes COVID. I know 2019 was there was a touch before COVID, but nonetheless, COVID really put a crimp into that. There were some weird numbers that resulted after that, but at any rate. So the next thing we're looking at, of course, would be the inflation. This goes back to December 2022, being at 6.5%. And the latest numbers coming forward to inflation numbers to December 2023, they're significantly lower than that. So when we're talking about employment, so we're hitting all three, basically here. So what I want to focus on is drilling down. There are two different surveys, if you will. One would be called the CPS, or the Current Population Survey, and the other would be the CES, I believe it's the CES, Current Employment Statistics. At any rate, one is considered the Household Survey, that's the CPS. The other is considered like the Payroll Survey. The distinction between the two, very, very briefly, is that the CPS, or the Household Survey, this is a relatively small survey, and we'll get into the details on this, but it's fairly accurate, even though it's a relatively small sample of, I think it's like about 60,000, we'll say, maybe less, maybe 40 to 60,000, where there are direct surveys where the Census Department calls people up and asks them about their employment status. The other is much, much more involved, and that is the CES, or the Payroll Survey, the Current Employment Statistics, and that is again, I think it's directly through the BLS, but the point is that they contact individual firms and institutions of size, not small businesses where there are one or two people working, but we're like more of a legitimate payroll type of a situation where you've got a dozen or more, we'll just say. And that's not necessarily the dividing line, but there's much more data gathered in terms of like hours worked and overtime and productivity. All the numbers kind of come through the payroll survey. At any rate, when we talk about the unemployment rate on a monthly basis, for example, this is something that's part of the monthly employment report. And I'll just walk through it very quickly. So first we're looking at there are various things that we want to focus on. One would be the labor force participation rate. So the labor force, again, as I pointed out before, would be the employed plus the unemployed. And the unemployed, this would be the U3, those actively seeking employment, right? So they're not employed but actively seeking employment. And that's divided by the civilian non-institutional population. The civilian non-institutional population are the people that are 16 years of age and older, that are not otherwise counted in whatever that institutional setting might be, like military, prison, nursing homes, where those numbers are captured kind of elsewhere. So we're kind of separating out the population a bit. So in January 2023, the employed number was 157 million, and the unemployed was 6.5 million. The labor force total was about 164 million. The civilian non-institutional population was 263 million. Remember, out of a population of 335 million. So the difference between the two would be, again, those people that are under 16 years of age or younger, if you will, and otherwise counted in institutions. That would be military, prisons, nursing homes, etc. So it's a fairly sizable chunk that are kind of separated out, right? But also remember, included in that civilian non-institutional population would be everybody in terms of retirees, etc. So again, that labor force participation rate is something important, and it's at in January of 2022 is at 62.2%. I believe this year in 2023, I'll get the number a little later on in this, was about 62.5%. So it's better. However, it's significantly lower than it was in January 2020 before, but just at the onset of COVID, it was at 63.4%. And those numbers is, we've never gotten back to that number. We still haven't gotten back to that number, I should say. Going back into the early 2000s, the number was closer to 67%. And the difference why that was that there was a collapse following the Great Recession, 2008, 2009. It continued to go downward. Part of it has to do with baby boomers retiring. That's part of it, and I've got more to talk about that going forward. So just kind of keep that in mind. It's lower, really. It truly is lower than where it ought to be, and we can. It's debatable about what level it should be at, and should we be closer to that 67%? Yeah. Should we be at 67%? Probably not. Anyhow. Okay, so on the left-hand side, that'll be very brief here. Again, we already talked about the labor force participation rate. Going back in the early 2000s, it was high as probably close to 68%. In fact, it was well over 67%, and it's deteriorated. It's certainly deteriorated more quickly as a result of the Great Recession in 2008, 2009, and they continue to go down, to drop down. Again, in part due to baby boomers, but there was more to that than meets the eye, because there were oftentimes younger age cohorts that were not. The BLS is interesting. Again, we'll talk about this at another point in time, but they separate the age groups out when they look at these employment statistics, and it's interesting to note that for many years there were younger people out there, say from age 16 to 25, that had fallen off significantly so far as their labor force participation rate. Remember, the labor force is equal to the employed plus the unemployed, and divided by the non-institutional population, the overall, that's the denominator. Point being is that you could say, well, they're more going to school, so on and so forth, but they were going to school before that too. So what prompted some of these things? And there's some, again, these are things that are kind of open for debate, but clearly that was the case. At any rate, so on the right-hand side, we see the age and sex structure of the population of the U.S. from 1945 going forward to 2060, if you will. And what you'll see is the progression of the baby boom, right? It's referred to as the pig in the python. And I think right now it's the up until the last few years, it was the largest cohort, it was the largest group within that that band within the population, and that hence again the term called the pig in the python, because it's that bulge, if you will, as it's going through the python. I hate to put it that way, but that's the expression, the way it's employed. And these are people that are born from they've got 1946 to 1964. That's traditionally the baby boom years, if you will. And that is a problem that will be, or I shouldn't say a problem, shouldn't say that, but that is a situation that is going to continue to cause issues in terms of uh, paying for those baby boomers as they glide off into their golden years, right? Because of such things as Social Security and also Medicare, etc. Just things to kind of keep in mind. It might be worthwhile just to stop and take a look at some of the graphs here. It's very interesting. So again, we're focusing on unemployment. In this case, we're looking at that U3 unemployment. And obviously, in going through the Great Recession, the unemployment rate was very high, and it was also high again in the year 2020 as a result of COVID. Dropped back down in 2021, and we'll see what the numbers are at on the next slide. However, it is interesting to look at these unemployment rates, the trajectories and the associated recessions that were there. And of course, during COVID, there was a recession because we stopped production for so long, for months on end during COVID. And that prompted us to move into a recession, if you will. Anyway, the types of unemployment. Four of them, basically. We're looking at cyclical, frictional, seasonal, structural. So cyclical has to do with our friend, the business cycle. So when we're at full employment, we have zero cyclical unemployment, meaning that if we have, so there's still unemployment at 3 or 4%, but it would be nothing to do with the business cycle, hence the term cyclical unemployment. That is our our thumbnail sketch view of what we call full employment when there's zero cyclical unemployment. Nonetheless, there's always other types of unemployment: frictional, seasonal, and structural. So frictional, of course, would have to do with well, I shouldn't say of course, but I mean, it would be a situation where you have a job lined up, for example. You have a job lined up, you're ready to go, and but the job doesn't start for another month. So you're not working. You're even though you have a job promised for you, you're still not working. So you would be counted as unemployed, and that unemployment status would be frictionally unemployed. The next would be seasonal, and of course that would have to do with the weather, with some weather related. If you work at a golf course in the winter, you would be either doing something else or collecting unemployment. Likewise, you could be working just in the winter as Santa Claus over Christmas, right? And the rest of the year you would be unemployed, or could be unemployed, we could say, classified as unemployed. Finally, structural. Structural unemployment is the one that's the most difficult to contend with, because what happens there is that your job disappears and it's gone for good. So perhaps you're working in a factory and your job was automated. So you went home from work and you came back the next day and there's a robot that's replaced you out there. This is one of the major concerns that are out there associated with, guess what? AI, artificial intelligence, these are things that are causing a lot of headaches, if you will, for economists in terms of trying to get their head wrapped around these things. But the real world out there, of course, is that these are things that are going to be presenting themselves going forward ever more so. Okay, so anyways, that's a quick look at that unemployment, that U3 unemployment. Drilling down on Michigan, it's kind of interesting. So typically, unemployment rates in Michigan are a bit higher than they are nationally. We're a little more subject to such things as cyclical unemployment for one, but also structural unemployment. As manufacturing jobs disappear, they're hard pressed to replace those. In order to the person would have to be retrained and would be off work for longer periods of time along those lines. So that's why Michigan has kind of tends to have a bit higher unemployment rate than the rest of the country. And again, like the rest of the country during COVID, it spiked to the moon because the auto industry pretty much shut down during COVID, and this would have been like that first month, April of 2020. Moving onward, again, within Michigan, we're looking at economic growth. And with economic growth, it's been kind of an up and down story with Michigan. Not always so wonderful. And most recently, 21, 22, this would have been COVID era, COVID time frame. It had fallen off significantly. This was the percentage real economic growth. It's termed GSP, gross state product, but this is our gross domestic product, if you will, at the state level. The takeaway with this is what I find very interesting is that with Michigan, we had going back, prior to Michigan has a tendency to go into recession earlier than the rest of the country, and unfortunately stay in recession longer than the rest of the country for a variety of reasons. But nonetheless, that certainly was the case going into the Great Recession in 2008. We had, going back to 2005, in fact, we had an economic growth of we were at 457 billion. That's 457 billion dollars in terms of the GDP, GSP. And it took until the year 2017 to get back to that level. This is unbelievable. So 12 years in order to get back to that previous level from 2005. Anyhow, that's just a quick look at drilling down in Michigan a bit. Okay, so these numbers are a bit more updated than the previous I had showing, but the GDP, so far as the U.S. GDP, we did have 3% growth rate in 2018, and things were looking up, and it tailed off in 2019 for a variety of reasons, and of course it went negative in 2020 to the tune of minus 2.2%. We ended up with going into recession, of course, because of COVID. 2021, question marks here because we popped up to 5.8%. Not really. This was a bounce back from COVID. So if you take the two, add the two together, that 5.8 minus the 2.2 gets us to 3.6, and divide that in half, 1.8% for the 2 years on average. Not all that stellar of performance. We picked it up again a bit in 2022 up to 1.9, and 2023 at 2.2%. We still have to get back to that 3%. That's our target. That's where we should be at 3%. Frankly, we should be much higher than that. The concern has to do with some inflation if we grow too fast, but I still feel confident that we could certainly get to that 3% level or better, if you will. Again, full employment tends to be so. Going back again, before the 2018, it was at 2000. We had to go back 2005 to get 3%, and prior to that, we were courting 3% or better quite often historically, but since then not so much. So that's something to really be concerned about. So the full employment again is considered to be around 3 or 4%, somewhere in there, and that's where we have zero cyclical unemployment. We can have what? We can have frictional, we can have seasonal, we can have structural, especially when you look at a state like Michigan. Historically, over the last 20 plus years, we've seen significant amounts of this structural unemployment. And finally, the current inflation rate, 12-month look back. So we're looking back over the previous 12 months, December 2022 through December 2023. I know that's probably would appear to be 13 months, but that's just the way that the BLS looks at it. And it's 3.3%. Which is above the targeted amount of 3%, or closer to 2% actually, but 3% that the Federal Reserve would like to see. Nonetheless, we've moved in the right direction. It's kind of fallen off a bit of late, but still the inflation level is much less than it had been in the last couple of years prior to this. So now we're just looking at just some terminology, GDP. Now we're looking at the per capita GDP. Whenever you see the term capita, that means per person. So the per person, I should say capita would be person. per person GDP. So we're breaking that GDP out to per person. So in the U.S., close to $20 trillion economy, but we divide that by that 335 million people in the population, right? That would get us to our per person GDP. Nonetheless, we're around the world, we are definitely a high income earning country. We're right at the very tip top, if you will, as you know, relatively speaking. And what you'll notice is that the largest economies in the world, the top three economies would be the U.S., followed by China. And some people say China's overtaken us. That's debatable and something that we could always talk about, but we'll just leave it that the U.S., China, and then typically it would be Japan. And then after that would be countries like Germany and a lot of other European countries mixed in there. Nonetheless, what you'll notice is that China, because its huge population of 1.4 billion, that per capita GDP is significantly lower in the $10,000, $12,000 per person category as opposed to the U.S., where we're $60,000 or better. So again, to kind of put this into perspective, is that we tend to think of the U.S. as having being the richest country in the world, and yeah, by most measurements it truly is. But if you look at it in terms of per capita GDP, per person GDP, all these other countries are well ahead of the U.S. And when I say ahead of the U.S., I mean the distinction between this is between the U.S. and these other countries. You could add all these countries together, and it would probably be less than half the size of the U.S. in terms of population. Probably less than 100 million in total. Could be. Anyhow, you get the idea. These are very, very small countries. So this is that per capita GDP concept that I was talking about. And it is interesting to see some of these countries with how high their per capita GDP is. I was a little surprised to see like Ireland being having such a high income, and a lot of that has to do with educated population for one, very low taxes. A lot of companies have their headquarters there, so there's a lot of commerce that's going on in places like Ireland. Macau is China, and that's a gambling center, and I'm guessing it would also have a lot to do with banking, along with some of these other countries, including just some oddballs that are out there like Falkland Islands. And again, that I'm sure that has more to do with banking than anything else. But anyhow, you get the idea. So again, I'll be brief with the discussion about inflation the last bit here. We're inflation, disinflation, deflation, stagflation. It's pretty straightforward when we have price levels changing, when we have increases in price levels from one period to the next, that would be inflation. So if we're going from 0% inflation one period, moving forward to another month, the inflation goes up to 10%. We have inflation of 10%. A lot of different ways of measuring it. Could be month to month, could be the year over year, could be that 12-month look back as talked about before. All these things kind of go, it depends upon what the metric is. So again, our inflation, our price levels increased by 10%, and then the following month, the price levels increase, but at a lower rate rather than at 10% at 5%. That would be disinflation, where we still have inflation, but at a lower rate. And then the following month, we have a negative 5% rate of inflation, which means that we would have deflation. Prices actually went down. Final category when we talk about these price level changes would be something called stagflation. And stagflation, basically what we're doing is we're combining an economy that's in recession or not performing very well at all, and we combine with inflation. Odd situation, because in many ways it doesn't make sense. When the economy is booming and doing very well, it makes sense there could be inflation involved, right? But in this instance, and we've seen this happen in the past, we've seen it happen very recently, in fact. But oil embargo, when we have a supply side problem, meaning we have supply issues, which was also what we experienced with supply chain problems during COVID, where there weren't enough vehicles being produced. So the vehicles that were available on the lot, the prices went up. We have inflation, right? And yet the economy is not doing very well, obviously. Anyhow, so that would be it for that discussion on price level changes. The next thing we're looking at, and this is completely different, switching gears, this is the circular flow of financial activity. So we've talked about the circular flow of real economic activity, and now we're going to be focusing, strictly speaking, on that financial activity. So when we talk about we break it up into two different categories. One would be external finance, external direct finance, or external indirect finance. Meaning that, I shouldn't even say external, but we'll just say start with direct finance to begin with. So if we're looking on, there are two different sectors, if you will. Actually three, I guess, if you include the financial intermediaries, but we're looking at deficit budget units on the left and surplus budget units on the right. And what that means is that to be a deficit budget unit means that you're a net borrower. Very common. I mean, if you look at the various economic sectors out there, if you look at government, that's obviously a deficit budget unit, right? With the $34 trillion in debt. And it doesn't, well, it doesn't really, it's not obvious, I guess you'd say. The firms are also deficit budget units because in order to grow, to expand, firms have to do what? Firms have to borrow. Firms have to. This is the way forward for firms. They have to borrow. They have to borrow, issue bonds and so on and so forth, right? And the surplus budget units then would be the household and also the international sector. So they're the funders of all this stuff that goes on. But more typically, when we're looking at this situation, we can talk about individuals, okay? So let's just say there's something called a life cycle hypothesis, meaning, of course, when you're young, it's more expensive. Things are more expensive, and you can't really necessarily go out and buy everything that you would like to have or things that you might need in order to, to live your life. Growing family, that in and of itself is very expensive. Paying for, a family, children, etc. Right? But when you start talking about other things like buying a home, it's a very expensive proposition to go out and buy a home. Typically, we have to do what? We have to borrow. We have to have mortgages. We have to borrow to pay for the things that we would like to use right now as consumers, of course, right? Including vehicles and other things as well, borrowing on credit cards, etc. Point being is that those are when you're younger, you tend to be a deficit budget unit. When you get older, you become a surplus budget unit. So the place for a surplus budget unit is that again, when you're older, we're sticking with this life cycle hypothesis idea. So you're in your senior years, your golden years, and you don't want to work as much. So how do you support yourself? That's where the surplus budget unit comes into play. So you have money, but you need to do something with that money. You need to invest it somehow, some way. So you have both sides that are desiring to do what? To make this exchange. So you've got the deficit budget unit that wants to borrow. You have the surplus unit that wants to lend. And of course, the meeting between the two has to do with what? The interest rate that's going to be charged. The interest rate that the surplus budget unit is going to be charging that deficit budget unit, and how much that interest that deficit budget unit is going to be paying for the use of those monies, the funds coming from the surplus budget unit. So this is the direct finance route, where you're borrowing from Uncle Vinny. Problem is that Uncle Vinny wants 10%, and all you want to do is pay 5%. Problem, correct? So there's a mismatch, and that's the cumbersome nature of it. It's almost like a barter type situation. And then along comes this indirect finance route up down below. And again, this is pretty straightforward. They are involved in claims transformation, meaning that they take ownership of something and then they pass this on in some way or another. And there are different forms that we walk through, various characteristics, including liquidity, maturity, risk, denomination, interest rates. So we're taking on risk and passing on risk, and the risk is flowing back and forth. Example. So you want to borrow. You're the deficit budget unit, and you would like to buy a home or whatever, and you'd like to pay. Well, we won't say home, but we'll use our example of that 5 and 10% that we were talking about with Uncle Vinny. So you want to borrow at 5%, and Uncle Vinny wants to lend at 10%. So the financial intermediary goes to Uncle Vinny and says, okay, you know what? We will borrow from you, not at 10%, but we will give you 7%. We will pay you 7%. Uncle Vinny says, well, that's better than my nephew with the 5%, and we're talking about an establishment that's well that's been around a while, and you feel much better so far as like the risk that would be associated with dealing with this entity versus your nephew, right? Anyhow, so we go ahead and make that deal. Financial intermediary goes and borrows those funds at 7% from the surplus budget unit, and then it goes over to you and it says, okay, I can loan you the money, but and you're saying, well, I want to borrow at 5%. You say, nope, I won't do that, but I will lend it to you at 8% rather than the 10% that your Uncle Vinny was going to charge you. So as a result of which, there's a 1% gain, if you will, from that financial intermediary in this transaction that occurs. Keep in mind that the financial intermediary takes possession of these funds. So it takes that money from the surplus budget unit, and it issues a promissory note to them, like a loan agreement on how it's going to be repaid. Then in turn, the financial intermediary is going to loan those funds to whom? To the deficit budget unit. The deficit budget unit is going to sign off on a loan promissory note back to the financial intermediary. So financial intermediary is borrowing at 7%, and the deficit budget unit is borrowing at 8%, and the financial intermediary makes that 1% differential. This is the way the financial system works. This is the beauty, frankly, of our financial system. It's quite excellent. When it works, it's great. When it doesn't, oh my goodness, right? We've seen this happen in the past. Nonetheless, bear in mind that our financial system in the U.S. is considered the top in the world, or at least it has been. I'm saying that guardedly going forward. So as I said repeatedly now, when we look at that the circular flow of real economic activity, we're looking at 4 different sectors: household sector, the private sector or the firm, public sector or government, and finally the international sector. So when we're looking now and we're talking about demand shocks, and we'll be getting into supply shocks as well, we've seen these before. These are shifts in supply. Remember now when we're moving from, in this case, we're moving from D2 to D1, moving closer to the origin, moving from D2 to D1, that would be a reduction in demand, or a shift in demand that results in a decreased demand, okay? Versus the one on the right, moving from D1 to D2, that would constitute an increase in demand, or more demand, right? So shifting from D1 back to D2 would be an increase in demand. So when we talk about demand shocks, they can come in either manner. They can either be a negative demand shock in terms of moving from D2 to D1, or a positive, if you will, demand shock, a good demand shock, moving from D1 to D2. So just to walk through again, demand shocks with heavy competition, they're self-correcting. They tend to even themselves out, if you will. When there's a lot of competition, they tend to kind of not last forever, right? Because there's an adjustment. So, for example, if we have here's the note here on inventory. When an economy suffers a demand shock going into recession, the first reaction is typically not to react at all. So you end up what? Building inventory. Inventories rise. And so what you're going to do in response to that is that if you have lots of substitutes, if you have a market that is not, we don't have, where you don't have market failure, where you don't have lots of market power, the price adjustment reduces that those surpluses, right? It reduces that excess inventory that you have there. So reducing prices was going to clear that inventory. So that's just an example. So again, demand shocks could go either way. It could be a good demand shock shifting from D1 to D2, or a negative or a bad demand shock, if you will, going from D2 to D1. I shouldn't be using the terms good or bad. That's not the case. It's just this is just a snapshot of what's going on, right? So conversely, or the other, we talked about demand shocks, but there can also be supply shocks. If supply shocks are, in some ways, supply shocks are kind of easier to get your head wrapped around. So a negative shock, for example, might be that you have a terrible crop, or you've got snowfall that wipes out the orange. I shouldn't say these things, but you could see how that could happen is that you would be shifting from S1 to S2. So that would be a negative supply shock. Or you have your corn crop failed because there were tornadoes that came in, or you had inclement weather and it wiped out your entire corn crop. So again, that's shifting supply from S1 to S2. Conversely, you could have a positive supply shock, or a good supply shock, for lack of a better term, where the opposite occurs, where you've got a bumper crop of oranges and you have a bumper crop of corn that comes in, and it's you have 25% more than you'd actually anticipated. So that would be shifting again your supply from S2 to S1 in this case. So very similar to what I was talking before about with demand side failure, supply side failure. That would be the restricting supply moving from S1 to S2, looking very similar, but these are shocks that are occurring out there that cause these occurrences. And again, back to what I was talking about, the sectors, household sector, the private sector or the firm, again, pointing to the circular flow, public sector or government, and finally the international sector. So putting these two together, when we look at the supply and demand, we talk about demand side failure, supply side failure. When there's market power present, I think I've used this example before, but rather than reduce prices, what happens is that, say for example, you have a shift in demand from D2 to D1, so a reduction in demand. You have demand side failure. So as a result of which, if your supply is still out there, what's going to happen is that you are going to be you would have a surplus. You would have a excess inventory. You could clear that excess inventory by, again, reducing prices. But let's just say, for example, you have price power, you have market power, and you do not want to reduce your revenue, or you don't want to reduce your you don't want to reduce your profit margins. However you want to characterize it. The way that you could offset that is by shifting your supply, by restricting your supply from S1 to S2. This is what happens when we talk about downward price rigidity. When you have market power, you have a tendency to not want to change prices. Rather than do that, you'll reduce the amount that you're actually supplying. So what drives that would be such things again as if you have labor contracts. So you're in a 5-year in the beginning of a 5-year labor contract or 3-year labor contract, and your prices are not going to change. So as a result of which, in order to you're restricted from being able to again reduce your prices to clear that inventory, to clear that surplus. So you don't have much choice but to cut back on your production. And this has happened significant, over the years. This has happened quite frequently. Your raw materials, lumber or uh, steel, where you might have a steel contract that's spread that you're stuck at that price for that production for the next 3 years, similar to like a labor contract. So this is where we have where there's market power present, there are sticky prices, and you have market failure is really what this is. So the response to this market failure is that if you have the market power, if you have price power, is to reduce your supply rather than again reduce the prices in order to clear those surpluses out. So when we're talking about when we're just drilling down, if you will, on your income, this is kind of a bit of a side note, but it's worth kind of going over. And that is when we look at payroll taxes. They're called payroll taxes because these are taxes that you can see on your paycheck. If you had a paycheck, a piece of paper, a paycheck, those are long gone those days. So electronically, you can see this. And first would be that the income tax, not first, but these are just walking through the different items that you would see. One would be your withholding tax at the federal, state, and oftentimes you might even have a local level if you're in a tax jurisdiction where local taxes are taken out on your income. Social Security is at 6.2% currently, and for each side, for the employee and also for the employer having to kick in. So if you are self-employed, yep, you get to pay both sides of that. So you get to pay 12.4% to cover that Social Security. That it's a Social Security tax. It's called a contribution, but it's a tax. A tax. And it's up to $168,600 in 2024, and it rose significantly from the year 2023. Medicare, so the Medicare is for elderly, paying for medical insurance for people that are 65 years in age and older, and there is no cap on that, meaning your income wages are there's no cap at all on it. So whatever your income is, you're paying 1.45%, or if you are self-employed, you get to pay what is that, 2.9%, the whole shebang, or the combined together, of course, would be 7.65 twice over, so that gets us to 15.3%, I believe it is, that we would be paying for again through these payroll taxes. So it's withholding taxes. That's paying for your income taxes as you go. So you're paying as you go for your income. As you're earning that income, you have to pay. And if you underpay that, if you take out too much, so far as your deductions are concerned, so far as like your exemptions, I guess you'd say, I forget the term exactly, for your for yourself and your spouse, perhaps, and children, and so on and so forth. And if you miscalculate and it's by too much, then you could end up paying a tax penalty for this, right? Anyway, that's just a quick walk through payroll taxes. So last little bit in this introduction on macroeconomics, and this is kind of an aside, but it's worth kind of looking at. And that is that looking at our aging population, right? So if we're looking at the zero up to newborns up to age 64 in the year 2010, it constitute about 88%, and that number's dropped down to roughly 80% in the year 2030, and in the year 2050, it will be down to 79%. The significance of this is that the other cohorts, the other groups that we're talking about are growing, of course. They're expanding, especially the 85 and older. And the older people get, the more expensive they get, right? Shouldn't say those things, but that is the reality. So these are all things, and the macro consequences of this is that they're going, with this aging population, that becomes more of an expensive proposition to do what? To keep them alive, to keep them fit and healthy, and so on and so forth. All kinds of other things that go into this when we start talking about gender, if we start talking about racial components, and so on and so forth. It becomes a very murky area. But anyway, it's just kind of interesting to look at this, that we have an aging population. It would be interesting to see some other countries like a China, for example. It's their problems are probably even more significant than ours are. When I say problems, these are challenges, right? Um, and similarly, or even more so, more pronounced would be countries like Japan or Soviet Union, or not Soviet Union. Listen to me. It would be Russia. Anyway, that's it for now, folks. Thank you.